Well, welcome once again to my studio here in fabulous Las Vegas. Today's lecture is on partnerships. Listen, I keep forgetting to say like, share, and subscribe. I think it goes without saying, but my goal has been this Q1 first quarter is to do social media, put these lectures on the YouTube channel, participate in subreddits, and do all that before resuming more of my corporate training role in the second quarter. So I'm not very good, getting better, but I appreciate your help trying to build a direct relationship with the consumer marketplace, if you will. And this is part of that effort. So if I ever forget, that goes without saying. I noticed on the previous lecture, which was the explication of 50 performance opportunities, I got lazy and didn't hook up the Yeti mic in the studio, and I wasn't pleased with the audio quality. So your thoughts? I'll probably redo it and take the opportunity to kind of maybe beef it up in terms of some of the answers and some of the questions. But anyways, we're back with Yeti, got the studio completely set up. So hopefully our audio quality is better. Okay, so we said investment vehicles are very important. I think a lot of vendors over do it when it comes to partnerships. 3-4 questions. This is appropriate for the SIE. It's appropriate for 65. SIE maybe, 1-2 questions max. 65, 3 questions, 4 questions max. Series 7, 4-5 questions max. So kind of like a margin. It's an area where you can really, really overdose. Now, that being said, we don't know which of those questions are going to be. And so we have to be prepared for any draw of the questions that I'm going to share with you. I would think that kind of like my margin lecture, I've been pretty honest when I think the lecture is sufficient and stands by itself and, could get you past the exam without any additional work. And I think that of my margin lecture, and I probably, when I get this one out, I think this will be sufficient for your test purposes. You spend your time in your study materials elsewhere. Anyways, if we're going to set up a partnership, we're going to need a partnership agreement. And there's going to be a subscription agreement, and the syndication fees are a max of 10%. So what does that mean? That means if I'm raising $10 million for a partnership, I can only spend $10 million raising the 100. So that's our max syndication fees. Now, remember, there's 2 ways to sell, whether it's a partnership interest or whether it's stocks, whatever the case may be. They're in primary transactions. We can either do a public program, 33, where we're selling brand new securities to the public, and we're going to give people a prospectus. That would be a public partnership. Or we can do it as a private placement. We can do it as a Reg D exempt transaction, or we're giving people private placement memorandums. I've done a lot of private placements, and I know people think I'm kind of being anal about it, but I used to get so aggravated when people would refer to the private placement memorandum as a prospectus. I said, listen, that is not a prospectus. That is a private placement memorandum. And the reason I get upset with that is we don't want people to think it's a public offering, because it's not, right? Now, remember, very testable on all exams. If we are going to do it as a private placement, an investment by invitation only, we can only invite accredited investors. Accredited investors, remember, have $1 million of net worth exclusive of their primary residence, or they make 200 grand for the last 2 years with the expectation of 200 grand this year, or they're married and filing jointly and they make 300 grand for the last 2 years with the expectation of 300 grand this year. Not testable, but a recent expansion of that definition. As a Series 7, 65, you are an accredited investor, meaning you're allowed to participate in private placements. So we're going to have a general partner who provides the expertise, and we're going to have limited partners who provide the money. So the general partner is the one who's managing the partnership. In the Golden State Warriors, the general partners are Peter Guber and Joe Lacob. They're providing the management. They have unlimited liability. That's testable. I gave you the example, I think, in the explication of a partnership question about Vivek Ranadivi, who is a limited partner in the Golden State Warriors and wanted to sell his partnership interest. And what he was upset about is he had the opportunity to be general partner. Joe Lacob invited him to be co-general partner, and he didn't want the liability. And he said, no, thanks. Now, the partnerships, the general partners are agents of the partnership. They're making decisions on behalf of the partnership. And so they have a fiduciary duty. They're supposed to be running the partnership for the benefit of the partners. I don't know what level of hell Al Davis is burning in, but Al Davis was the managing general partner of the Oakland Raiders. In the partnership agreement, it takes 2/3 of the partners to remove the general partner, and Al Davis owns 40%. So there's no way that they're going to remove Al Davis as general partner. One of the partners who owned 20% of the Oakland Raiders partnership died. And the state wanted to sell the 20% interest. And the general partner, Al Davis, said, well, you can only get in or out of the partnership with my permission. And I can only see one person I would accept as being somebody who could buy that 20% interest, and it's moi. And so now he owns, Mark Davis now is his son, who's the general partner, owns 60% of the Raiders. So that's a partnership. No retained earnings, the profits or losses flow through. By the way, we can sue the general partner, and God knows general partners get sued all the time for not carrying out their fiduciary responsibilities, where the limited partners are saying the general partner is running the partnership for their own benefit and not for the general, not for all the other partners. Again, lots of sports teams are partnerships, and right now the Washington football team has two limited partners who are suing the general partner and vice versa. Now, as a limited partner, you're providing the money. So limited partners are providing the capital. General partner provides some too, but general partner provides the experience, limited partners provide the money. I'll probably, as the title of this lecture, put a joke that we refer to sometimes about partnerships, where we say, the general partners provide the experience, the limited partners provide the money, and then at the end of the day, the limited partners have had the experience, the general partner has the money. Limited partners test question have no management responsibility, and they wouldn't want management responsibility. Long story, but the partners voted to kick the general partner out of this. We had a chef that my clients and I had financed. It was a partnership. He's the general partner. And we said to the chef, the partners have met and you're no longer the general partner. We booted the chef to the curb. And anyways, one of my clients and I, Brian, we decided that we were going to be the general partners because who else is going to take, the reins here if it ain't us? Anyways, one of our fellow partners was a guy named Jason. He kept coming in and, playing like he's, general partner. And I said, Jason, check with your attorney, please. But he'll tell you, I'm not giving you a hard time, that I'm doing you a favor. You don't want to be deemed to be a general partner here, because then you're going to have unlimited risk. And you have way more resources than Brian and I. And boy, if something goes south, people would really much prefer to come after you. So it'd be very important as a test issue. Make sure, let's just go ahead and get started here on our annotation. It would be very important for our partners to know that they shouldn't and wouldn't want to be involved in the day-to-day operations, right? Because then they could be deemed to be a general partner. That'd be a big no-no. They're not an agent. You better not be acting as an agent of the partnership as a limited partner. You say, hey, I'm just a limited partner. I just provided some money. I'm here to, have some wine or whatever, the winery, right? I help finance a winery, and the general partners are running the winery. That's not our job. God knows we wouldn't want to do that. Our job is to go to the partnership meetings and get our distributions and drink some wine. All right. Well, the IRS doesn't like partnerships, and the reason they don't like partnerships is because of the flow through of the income and the losses. They don't like that. They would prefer it's a corporation. People don't understand partnerships. Some of my friends were saying, what do you think he makes at that law firm? What is his salary? And I said, well, he doesn't have a salary. He's a partner of the law firm. He wouldn't want the law firm to be a corporation, because if the law firm was set up as a corporation, some are, some aren't, but if it was set up as a corporation, that would mean the corporation would make money, pay taxes, pay a dividend to the owners, who would pay taxes, pay a salary to the attorneys, and they'd pay taxes. At the end of the day, what happens is all the money flows through to the partners, and he's a partner. I don't know what the flow through of that is. It's, my guess is it's $1 million at least. I always like to be around when there's a distribution from his law firm partnership, because, very hospitable with what's going on. And you can get a lot of people to work very hard on the idea that someday they might make partner. P.S., by the way, just going back here, all private equity funds, venture capital firms, and hedge funds are set up as partnerships. So that means there's a general partners, the limited partners. The limited partners in those venture capital, private equity, and hedge funds, those are all private partnerships, remember that, private placements. And those limited partners are accredited investors. I bring that up because, again, in one of those firms, again, like the law firm example, you want to work very hard to make partner. If I tell you you're not on partnership track, that means, there's not going to ever be a flow through of this money to you. You're just going to get paid a very handsome salary at the venture capital hedge fund or private equity fund or law firm, whatever the case may be. So we have to dissuade the IRS that we're not a corporation, because we don't want to be. The IRS says if you look too much like a corporation, you quack too much like a corporation, you are a corporation. And we certainly don't want to be that. So we're going to have 6 corporate characteristics here. And what we're going to get tested on is what is easy to avoid. And so we're going to go through the list, and then we're going to find out what is easy to avoid, because we have to avoid at least 2. If we don't avoid at least 2, then we're not going to be a partnership. Now, this first one is going to be very hard to avoid because, as far as the IRS is concerned, to say you're an owner, or shareholder, or limited partner in the enterprise is the same thing. So associates known as owners, shareholders, or limited partners were 0 for 1. 0 for 1. Now, we better not say that unlike a corporation, we're trying to avoid a profit motive, right? Say this is a tax shelter. No. We can't let the tax tail wag the investment dog. Now, we are allowed to say that the tax benefits are important, but they're of a secondary importance. Trying to make money is the most important thing. So we're 0 for 2. Now, by the way, if the IRS comes back and says that we've organized this partnership as a tax shelter just to lose money, they'll disallow the losses. They might even prosecute us for fraud. So, not going to be not bueno, right? So anyways, we're 0 and 2. Corporations have centralized management. They have a board of directors and they have officers, C-level officers, the president, the chief operating officer, the chief financial officer. And so corporations have centralized management. So do partnerships. We have a general partner. And to say that Joe Lacob is the managing general partner of the Golden State Warriors, to say he's the CEO, intellectually, we're not batting so well here because we're now 0 and 3. Corporations have centralized management. Partnerships have centralized management. In a corporation, as a shareholder, you have limited liability. Nobody ever calls you and says, hey, your stock went to -5. It can just go to 0. So we're 0 and 4. To the rescue, to the rescue. So to the rescue, the 2 that are easy to avoid are freely transferable interests. In a corporation, you can sell your stock to someone else, and you don't need permission from the corporation to do so. That is not true in a partnership. In a partnership, you do not have a freely transferable interest. You can only be admitted to the partnership or emitted from the partnership by the general partner. Now, that has a couple of follow-throughs. Not only is it a test question here in terms of how we avoid being deemed to be a corporation, it also has a flow-through to, suitability. If you don't have a freely transferable interest, that means that partnerships are not liquid. And so it would be a totally inappropriate recommendation to somebody who needs their investments to be liquid. Partnerships have a finite life, Corporations have what's called inter vivos, a life of their own. They go on and on and on and on. Not true of a partnership. We're going to say, okay, we're going to liquidate the partnership in 5 years or 10 years. Goldman Sachs was formerly a partnership for over 100 years. Every 2 years, the partners at Goldman Sachs would meet and say, all in favor of carrying on the partnership for another 2 years, say aye. And for 100 plus years, every 2 years, the partners did that. Now, we don't expect that a corporation is every 2 years they're going to discuss liquidation. The last time they took the vote, John Corzine, who was the managing general partner of Goldman Sachs, said, partners, before we vote about continuing the partnership, if that vote fails, I would like to recommend that we reorganize the partnership. We get rid of the partnership form and reorganize as a C Corp and go public at 5 times book. So we're going to take a vote about continuing the partnership. If that's more no's than yeses, the next vote will be reorganizing as a C Corp and doing an IPO. Again, proof here that partnerships have a finite life. That partnership is no longer around. So now, as it relates to us as investment vehicles, what we typically do say is we're going to raise this money and we're going to go out and buy whatever, The one I always refer to in my lectures is one I was involved in called Del Taco Restaurant Properties. We're going to go raise $8 to $12 million, buy all cash real estate in California and build Del Tacos. We're going to get 12% of the gross food sales. And in 10 years, we're going to package up the portfolio and sell it to someone else. And so we're hoping we're going to get the income stream, the 12% of the gross food sales from those restaurants. And then we hope that again, to 10 years, the real estate will be some worth more money and we'll be able to get some total return. So test question is, which two are the easiest to avoid? And those are freely transferable interest and continuity of life. All right, so here's what limited partners have. So limited partners have limited liability. You know, we live in a very litigious society and you can always sue, right? So limited partners can sue the general partner. I can't tell you how many times I've seen this. As I said, it's happening right now with the partnership called the Washington football team. The two limited partners are suing Dan Snyder, who's the general partner. The partnership has democracy. We can vote. Whoop. Let me get out my annotation tool. I just gave you an example of this. I said, hey, chef, you are the former general partner of this restaurant. The partners have met, and we voted to switch the general partner. By the way, when we had that partnership meeting, we had put on the ballot, maybe it's just time to go home. You know, a lot of the partners say, well, you know, if we don't have a chef, you know, maybe it's just time to call it a day. You know, so we can certainly dissolve the partnership. Typically, remember, we will dissolve the partnership at some point because remember, partnerships have finite life. We said test question, limited partners have no management responsibility and they wouldn't want management responsibility. You can monitor the books and, you know, records of the partnership. I've seen even lawsuits about this one in terms of that right. What's the general partner do? As we said, test question, the general partner has, whoops, sorry, let me get out my annotation tool here. The general partner, remember, is providing the expertise, but they also have unlimited liability. So if somebody asks you to serve as a general partner, you should kind of know if you accept that and become a general partner, then you have unlimited liability, right? As the general partner in that restaurant, I have unlimited liability. We have a management responsibility. Remember, we're supposed to be managing that restaurant for the benefit of, or whatever the partnership is, the winery, the Golden State Warriors, the portfolio of commercial real estate, whatever the case may be. We have a fiduciary responsibility. You know, you should definitely know that fiduciary means acting in the best interest of a third party. That's what that means to say you're a fiduciary. It's a legal term. So the general partner has a fiduciary responsibility to the partners. It'd be a conflict for the general partner to borrow money, to compete against the partnership, or to commingle. You know, commingling is when I put my money and the partner's money in my account. I say, your money, my money, what does it matter? So commingling would be a big no-no. What we're looking for, the opposite of commingling, would be segregation. You know, we keep the assets of the partnership separate from that of the general partner. Again, I can't tell you many stories I've seen of this where, you know, there's a lot of commingling going on and the general partner is actually using partnership resources as his or her own. Liquidation priority. Well, as we said, the whole idea here is that we're going to form this partnership. We're going to, you know, make some acquisitions, whether it's commercial real estate or, you know, raw land, or buy some airplanes and put them out to lease, or go find some oil and gas, whatever the case may be. And then we said there's a finite life. And so then we're going to liquidate. And so priority in liquidation is going to be the secured creditors. By the way, this is no different than any other kind of business that we liquidate. And what we're hoping when we liquidate, by the way, that, you know, there's some, you're going to have more money coming back to you. You know, partnership's kind of opposite. You know, what I mean by that is, you know, in other investments, you get a return on your capital. And at the end, you get a return of your capital. But in a partnership, you start by getting a return of your capital. The original distributions coming back to you are a refund of your principal. And then what you're hoping is the partnership still has some value, still making distributions. You know, well, I mean, I joke. I mean, if you had invested as a partner in the Raiders, oh my goodness, That was one of the most successful investments you ever made, right? You've got all your money back and you're still kicking around getting distributions. Pretty awesome. The New York Yankees, for example, is a partnership. George Steinbrenner, I think, is the general partner. What he paid, I don't know, some ridiculously low amount of money. The other creditors, limited partners, and then make sure you understand that the general partner gets paid on the back end. So the general partner, usually puts up a small portion of the, initial of capital, and then on the back end when we sell, he gets paid typically more. It's not testable. That's called disproportionate sharing. So general partners get paid last. I would know that as a test issue. Various types of direct participation programs we have available. When you're making a direct investment here, you're not going through a corporation which has a wrapper, right? I mean, when I invest in Exxon or Chevron, I'm not really making a direct investment into oil and gas. I'm not in the oil and gas business. Chevron or Exxon are. In a partnership, I'm actually directly investing into the underlying asset. So those are synonymous terms for test purposes, direct participation in programs and partnerships. So we have equipment leasing where we form a partnership. We go out and buy, it doesn't have to be airplanes, but airplanes are very popular. We buy a portfolio of airplanes, we put them out to lease, and the lease payments that the airline companies make will be sheltered by the depreciation of that asset. We'll talk about depreciation. Depreciation is for things that have a useful life. And so it's a non-cash expense. You don't get to use the assets for free. I mean, at some point you got to replace the airplanes, right? So that's a non-cash expense. We'll talk a little bit more in just a little bit. We have partnerships where we go out and do historic real estate rehabilitation. Test question. These two, I apologize that I'm going to have to review my screen. Something's going on with my studio screens here, but I would definitely know that these two provide tax credits. A tax credit is a dollar for dollar whack out of your tax bill. And boy, the idea here is that maybe enough capital wouldn't flow to historic rehabilitation and low income housing of its own free will and accord. And so to attract additional capital to these two things, I mean, taxes are built on the assumption that people respond to incentives. I'd say, hey, well, listen, besides how other partnerships work, this partnership is organized and going to restore historic real estate to its former glory. And low-income housing, a tax credit. One of my favorite places in San Francisco, if you ever visit, if you walk up to Jackson and Montgomery in the financial district, there's an old brick building that's been restored to its former glory. It says, William Tecumseh Sherman was a market maker here. Before the Civil War, he provided liquidity in mining stocks. Now, the building that is in, that brick building that's been restored to its former glory, by the way, I'm happy as a taxpayer. We don't need any more ugly boxes in the financial district. Has been restored by the doctors in the building. They formed their partnership, right? They all kicked in some money as limited partners. They picked one of them, I don't know who it is, to be a general partner. Maybe they got a real estate guy to be the general partner. And, now they're in there with their medical offices. And not only do they paying rent kind of to themselves, but they also got that tax credit. As I've said over and over and over again, the only two ways you can make money in any investment is income stream and or price appreciation. And so in raw land, there is no income stream. And so if we organize a partnership to go out and buy raw land, not making any more of it, I said, listen, we're going to buy some 10,000 acres. The partnership, there's this ranch that sits out close to the suburbs. It's not quite the suburbs. The suburbs are getting out there. And we're going to go form a partnership, buy that 10,000 acres. We're going to sit on it for 5-10 years. And then we're going to flip it. We're going to hope we're going to be able to sell it for more. The test question here is knowing the investment objective of that partnership. We say we're going to buy some land and we're going to build some new apartment buildings, or we're going to build some commercial real estate. And again, there's no income stream, right? Because we don't have any tenants. So the idea is we're going to build this new place, then we're going to find some tenants, and then we'll have appreciation again as our major objective. Because if there's no income from the investment, then we're after price appreciation. Well, if we buy existing properties, that's less dangerous, right? Because we already know what the income stream is. In real estate, that's called the cap rate. So we actually know that based on the price we're going to pay, we're going to have some immediate cash flow potential. Now, I have a question mark next to a mortgage. And the reason I have a question mark next to that mortgage is because we have this concept where the partners are going to borrow money. You know, the partnership on behalf of the limited partner is going to go borrow some money. And what we're going to say is that when we get there, I'm going to refer back to this. Now, this is more of a practice question issue. You know, I have a lot of people who are studying very hard. Probably not a lot of people listening to this call are getting 4 months with pay to study and pass their exam. But these men and women are, and you can imagine they really get into the weeds after 3 months of studying. And they'll call me and say, Dean, what's this idea about the mortgage bond? It's recourse and non-recourse. I'm going to go over that with you, not as a test issue, but a mortgage is a non-recourse debt, but it does add to our cost base. What we mean by non-recourse is if the partnership gets a mortgage to buy these apartment buildings or hotels or whatever it is, there's no recourse to the partners, right? Just like any other mortgage transaction, if the partnership defaults, the bank just comes and takes our apartment building or, our hotel, whatever the case may be. So that's what we mean by this idea of non-recourse. The only thing the creditors have recourse to is the real property. I'll bring that up again, more as a practice question issue than a real issue on the test. Here, oil and gas programs. So we have oil and gas programs where we form partnerships. Exploratory, we boldly go where no one's gone before. We drill a hole. We either win big or we lose big. Now, we don't test you on your ability as an investment professional to call your client and say, hey, that partnership where you're a limited partner, where we were doing the exploratory, we hit gas, oil and gas. Anybody can make that call. We always test you on the risk, right? A wild cat goes places other cats don't go, right? And so very testable. That's our highest risk, highest reward oil and gas program. Now, listen, and we're looking here at this guy who found some. Looks like they found some. That doesn't look like that's a wildcat program. Looks like they're actually, drilling. This looks like they, are drilling. And so the idea is if this guy found some and we go over here, we'll probably find some too. So a developmental is a little less dangerous because we go next door to somebody who found some. If they found some, it's likely we're going to find some. They've been drilling along this ridge you see here. Here's that ridge they're drilling along, and we just continue doing this. At some point, we probably won't find it, but along the way, we probably will. I've not as a participant, but well, I guess I could consider myself a participant. I guess it depends on how you want to consider a participant. Anyways, Angola has a shelf where there's a lot of oil and gas, and Chevron is the person that's involved there. There's a lot of stuff going on. But again, this would it's like a step out program. So the shelf in Angola, as it goes out into the Atlantic, all of a sudden just drops, and then there is no more oil and gas. But if you follow that trough, it comes back up in the edge of Brazil. And so the idea here is that, again, step out. If we found some off that continental shelf of Angola, we might find some off that continental shelf of Brazil. My other favorite story is I was in Hobbs, New Mexico. Who would have thunk this? And I was walking around town in the evening, and everything was Permian Ford, Permian Park, And I said as a joke, I said, if I were a broker in this town, I wasn't joking at the time, but this part was a joke. I said, I'd be calling the Permian family, man. They own everything. Permian Ford. They all started roaring with laughter, and they said, Dean, you're in the Permian Basin, son. This is one of the largest formations of oil and gas. That's not a family, it's a geological age. Oh well. Combination would be a little bit of both, right? Exploratory and developmental. Now, test question. So we said this is a test question to know that's our highest risk and reward, and this is a test question. Now, I didn't say that oil and gas income programs are safe. I said as oil and gas income programs go, that would be the safest. I just brought up the Permian Basin. There's no doubt there's oil and gas there. So I say, listen, we're not trying to find oil and gas. We're going to buy proven producing reserves. And what we're after there is income. And so that is the safest. Now, again, I'm not saying an oil and gas income is safe. I'm saying as oil and gas programs go, that would be the safest. By the way, the vast majority of partnership questions are usually the types of partnerships, direct participation programs we have that would, fit the investment objective. I have in the suitability exam a question about a lady who's considering buying Chevron or Exxon, and they're in the oil and gas business, and they pump it, they refine it, they make or lose money. And here we're getting rid of that. We're going to go directly into that business, make that direct investment in the asset, and we will have the flow through of the income and the losses. Taxation. I've had a lot of requests for taxation lectures, and it's kind of like suitability. I think you should, who knows, I might honor that, I may not, but the way to handle taxation, and my recommendation is that as you go through each of the investment vehicles, that's the time to know how that investment vehicle is taxed. I think instead of like a separate, category called taxation, you just should know how various investment vehicles are taxed. Please note, nobody expects you on this test to be an accountant, or be a tax person. We do expect you to have a general understanding of the tax consequences, because we don't want you to not be so foolish that their accountant says, hey, listen, you need a new broker, this guy, your new investment professional. So expenses are deductible in the current year, right? So just like any other business, the partnership gets to deduct expenses. So whatever we're spending in the partnership is deductible in the current year. It's real money, but it's deductible. That might affect that, right? Cost recovery systems. Now, that is not real money. But as I mentioned, you don't get to use assets for free. You don't get to use assets for free. And so to reflect that we're going to have to replace the assets at some point, we're going to do what's called depreciation for things that have a useful life. Non-cash for assets that have a useful life, because again, we're going to have to replace those assets at some point. Now, again, this is how we get rich, particularly in real estate, right? We're saying it's going down in value, but in reality, that's an accounting fiction. It's actually going up in value. Same with equipment. If I'm using, a pickup truck or something, to do Dean's lawn mowing service, at some point I need a new pickup truck. The Embarcadero is a partnership. It was formed by a capital provided by the limited partners of the Rockefeller family. It cost $300 million to build the Embarcadero complex in San Francisco. It's hotel, retail, commercial office buildings. There's 4 office towers there. And, in 1974, a commercial real estate has a useful life of 29 and a half years. Let's call it 30 to keep my math simple. The math's not testable, but we're going to say 300 million divided by 30. We're going to say that the Embarcadero commercial complex is worth $10 million each year. Wow. That's not really true, because it's going up in value, not down. But by the way, that $10 million in depreciation will shelter all kinds of the lease payments that we're receiving from the tenants in the office part of it, or tenants in the retail part of it, the lease payments from the hotels. A lot of that is going to be sheltered. In fact, we might even report a loss that is just a function of the depreciation, not a function of reality. Depletion is for a natural wasting resource. A natural wasting resource. Now, I don't know how much oil is down there, or how much gold is down there, but I do know this: when I pump a barrel and I sell it, there's 1 barrel less. And so the depletion allowance is to give our partnership an incentive, or anybody in this business, to go find a replacement barrel or find a replacement ounce of gold, whatever the case may be. This is the real money. This is the real money. So, if we have an apartment building and we're collecting from the tenants, so let's say we're a partnership and we're collecting money from the, the apartment building. We have revenues, and we're going to have operating expenses. The depreciation, remember, is not the real money. We're actually saying our apartment building is going down in value, and that may or may not necessarily, that accounting fiction, be true. And then we have our interest payments on the loan. I'm going to show this to you with some numbers here in a sec. Now, there are three baskets of income. There are three baskets of income that you report on your tax return. And so, we have our paycheck, we have portfolio, and what we're talking about right now is passive. So, let me just get out this here. So I think of this as your paycheck income, you working for money. I think of this as your portfolio income, your money working for you. And this is what we are talking about now. This is what we call your passive income. This is your partnership stuff. Now, what the IRS calls this is a little different. So the IRS is going to call this earned income. The IRS is going to call this unearned income. And, as I mentioned, as a practitioner, I don't really care about this in terms of testing, right? As your investment professional. What I'm hoping is that you have enough paycheck income that I can redeploy some of it into investments. Because the idea is we want to get enough money working for you that you don't need to work for your money any longer. I mean, that's kind of the game plan. So I'm going to sit down with you as your investment professional and say, okay, do you make more than you spend so that we can redeploy that? Maybe dollar cost average, whatever the case may be. I have a friend, Tim, he said, Dean, I'd like to talk to you about investments. And I said, well, Tim, how much money do you have left over at the end of the month? And he says, well, nothing. And I said, well, then there's nothing to discuss. I said, what you really need is a career counselor. You need somebody who would help you find a job in which you make more money than you spend. Now, when we go over here, now this is the area that is on our exam. We're going to buy you stocks and bonds and mutual funds and all kinds of other investments. And as I mentioned, we're hoping that, we're going to get enough of that going for you that you don't need to work anymore. But, you can take $3,000 from there over to here. So, for example, if I made $90,000 in paycheck income, W-2 1099, and I net out all my portfolio's gains and losses, let's say when I net it all out, I actually lost $30,000. Well, as I said, you can't take this to 60. What you can do, though, is say, okay, say, I'm going to use 3 of that. That's now 27. I can carry that forward. And I can take that against that and say, I made 87. And so now we're talking about this area of your portfolio. Nothing here can come across that. So any partnership activity losses or passive income you get is kind of stuck in that basket. So if we have a partnership where the revenue exceeds the expenses, this is just, Dean, I just call that a pig. And that's not a test term. That's just how I think of it. It's a passive income generator. So you're going to have a K1 that shows that you had a pass through to you, a distribution, and you're going to owe taxes over that on that. And that's going to be stuck over here, right? It's going to be, you can't be doing anything over there. Now we have a partnership where our passive activity losses, we'll talk about that when we show the accounting in just a little bit, exceeds that your K1 is going to show a loss. And again, that loss would be stuck over there, because you can only use it in that area. So we're talking about this passive area of your portfolio. We said nothing from this basket is going to go anywhere. So that leads us to a suitability question that I explicated in that thing. But, if you have a passive activity loss, then we want to find a partnership that has passive income or vice versa. Let me get my eraser. If I have a passive income generator, if I have a partnership in which I'm getting a K1 that shows cash distributions, I might want to say, hey, why don't we get a little aggressive here and go get that oil and gas exploratory program. And at least if we do, lose money, we can write it off. So the test question here is twofold. First is this idea that you can't move things from one basket to the other that happens in your partnership area. And then the suitability question, they'll say a customer has a large amount of passive income. What might you recommend? You say, okay, well, I think what I would recommend is perhaps a oil and gas exploratory program. By the way, I'm not recommending we do something to lose money. I'm just saying let's get aggressive. Rupert Murdoch lost $100 million in an investment called Theranos, and when they were asking about $100 million, he said, "Well, I could use the loss this year." I go, "Wow, I wish I lived in his world." Anyways, I have actually made some big time commissions based on this concept. I had a client who said, "Dean, I'm not going to invest because I have, it's embarrassing how many passive activity losses I have." And I said, "Well, even more of a reason you need to invest in my program, because this is a pig. This partnership I'm recommending to you, doctor, throws off cash, and you can collect the cash without any tax consequences because you told me you already have a bunch of this in this area of your portfolio." Now, the cash flow is the real money. Remember, we said depreciation is a non-cash expense. And so cash flow is real money, real money. And so let's just show that to you. I mean, don't go overkill. I told you, whether it's Past Perfect or STC or, Kaplan, I can't tell you, most of them go way overboard on partnerships as it relates to what you need to know to pass your exam. All right, so I'll play general partner. You play limited partner. So, we formed a partnership. We went out and we bought a $275,000 property. We came up with 240 grand on the mortgage. Now, remember that mortgage is a non-recourse thing, but it does add to our cost base because, what we mean by non-recourse is if this apartment building doesn't work out, they just come get the apartment building, right? They're not coming back at the limited partners. Our mortgage is 10%. So we collected 48 grand in rent. That's real money. We spent $15,000 in expenses. Now, remember this next line, depreciation, is a non-cash expense. It isn't real money. So, right now, as it stands right now, we have what, 33 grand? Let me get my calculator here. In real money, I'm just going to do that, 45 minus 15. So we got 30 grand so far in real money. That is not real money. Right, that is us saying that this apartment building is worth $10,000 less this year than it was last year. We paid 24 grand in interest expense on the mortgage, and that actually was real money. So we have $6,000 in our checking account, but your K1 is going to show your proportion of that loss. Remember this, you have a passive activity loss. And so I said, well, don't get upset. Who cares about that? What we really care about is the real money. Can you not use a loss on your tax return? This is a passive activity loss, and you're going to have your share of that. And you say, well, Dean, I'm not quite sure what you mean. I said, well, let's talk about the real money again. So now let's talk about the real money. Remember, the depreciation is not real. Let me go back and... Remember, this is non-cash. That was not real money. All right, so let's talk about the real money. The real money is cash flow, right? That's the real money. So we actually had a loss of 1,000, but remember that 10 was not real. And so it looks like Dean did the math wrong. We had $9,000 in cash flow. That's what we really care about. But what's really cool is you didn't have any tax consequence on that, right? You didn't have any tax consequence on that because, again, that's what we put in our checking account, but we actually reported a loss. So kind of cool. We reported a loss, but we had cash flow of 9 grand. So that's the real money, real money. Your cost base is going to determine the profit or loss when we liquidate the partnership. So recourse debt adds to the basis. Again, a lot of people get hung up on this. Again, I'm telling you, it's more of a practice problem issue with your provider than it is a test issue. But, I'll use the Golden State Warriors because I'm familiar with that. 2010, was many years before I retired, a season ticket holder of the Warriors before we were good, sat on the floor. And long story short, in 2010, I was sitting on the bar watching the San Francisco Giants in the World Series. Tony's been my server forever. I said, hey, listen, I just need some good real estate, big screen, and I'm set. Anyways, this guy starts hovering around my table and he says, what do you think about the new ownership group? And I said, well, I'm not a big fan of the partnership model. I said, I was hoping for the sole proprietorship model. I was hoping for Larry Ellison. I was hoping he'd drop 400 million plus and have, 60 billion behind that. The idea that me and 20 of my friends are going to come up with 20 million and we're going to go buy the Warriors, that doesn't speak to me. I'm going on and on and on. And he goes, well, my name is Joe Lacob, and I want to introduce myself as the general partner. I said, well, listen, I got to walk that back. In a gazillion years, Chris Cohan would never ask me what I thought about anything. We still weren't good, but we got to start to get better. And I used to tease him about, well, gee, I'm missing Larry less and less as we got better and better. But anyways, of those partners, a lot of them probably didn't put up 20 million. What Lacob does, he's a venture capital guy, so he's familiar with this partnership format. He says, listen, your investment is $20 million. That's, your partnership interest in the Warriors. But you only need to put up 3 of that. What I'd like you to do is sign a recourse note. I'm going to go to the bank, and the partnership on your behalf is going to borrow $17 million with a recourse note. Your cost base on the Warriors is $20 million, $3 million that you put up, and $17 million that the partnership borrowed on your behalf with recourse back to you. Now, if this works and goes according to plan, you're never going to hear about the $17 million because the partnership, the Warriors, will pay back the borrowed funds. But if, it doesn't work out, the bank is going to call you and say, hey, remember that recourse note you signed for $17 million? You need to make good. Now, in my example, if you put $3 million up, that's cash, and then you borrowed $17 million with a recourse note, the partnership borrowed on your behalf, your investment in the Warriors is $20 million. Now, on the other hand, if I say, same kind of scenario, I say, listen, we're going to go borrow money on the partnership is going to borrow money on your behalf, but there's non-recourse. That means the partnership doesn't pay back the borrowed funds. They can't come at you. So same thing, you put up 3 million, but we borrowed 17 million on a non-recourse note. The partnership borrowed that on your behalf. Your cost base is 3 million. Now, the reason that's important is because we might want to have a higher cost base to get more tax benefits, right? A return of our capital, things like that. Now, the one that people get hung up on all the time is this idea about mortgaging the real estate. Because I said that's non-recourse, but that does add to our basis. But that's really, by the way, none of this is really, I think, a test issue as much as it is a practice question issue. This idea of recourse. I can't tell you how many people are working hard, they're studying. And I think if you're working hard and you're studying and you got a question, you're entitled to get it answered. But, I doubt, very, very unlikely. Now, listen, in all these lectures, if I ever tell you something's not on the test and then you encounter it on your test, please call and say, hey, Dean, I saw it. And I'll say, okay, well, I stand corrected. I had a guy who asked me about variable life, and I said, don't worry about it. And you're not going to see any questions on it. And I got a variable life question. By the way, when I went over it with him, it was really just a camouflaged mutual fund question about the separate account. But oh well. By the way, I started numbering the slides. I didn't do it here. So moving forward, I will number the slides because, I want to be able to tell you, well, just tell me the number of the slide. Or, the practice question has a number in the bottom right-hand corner. If you want to discuss things further, I'm more than happy to do so. Tax benefits. So remember this, you better tell the IRS that wasn't the primary motivation. But partnerships do have some tax benefits. They have the cost recovery system we talked about called depreciation, which shelters the cash flow, the real money. We have tax credits. We said that's very testable. And remember, we said there are 2 types of things that will give us this tax credit. We said historic real estate and low-income housing. That is very testable. I would definitely know that. We said the losses flow through and they can only offset passive income. So we said you want to match your PIGs, your passive income generator partnerships, with your pals. That's not a test term. That's just a way I like to think about it, organize it in my mind. So a partnership is either going to give us a K1 that throws off losses or doesn't. A question that shows up, I see on debrief, a lot of people told me they've seen it. Another thing a partnership might provide is exposure to non-correlated returns, meaning the return on your partnership isn't correlated with the stock market. That's what that means. And that too, I've had people tell me they've seen that as a suitability question. Why would you buy a partnership? Now, what are the risks? The risks are recapture. So recapture means we've said this Barcadero is worthless, right? It's 2004. 30 years, we've used all the depreciation, and now we sell the apartment, the hotel, excuse me, the Embarcadero for $1.3 billion. Well, you know, we got a huge capital gains tax, right? So, you know, the idea here is that someday we're going to, you know, have some tax consequences. So recapture means we've said the asset is worth X, we sell it for Y, we've recaptured that, we owe taxes on that. On IRS audit, they said, man, those numbers are so terrific. Why don't you come down and explain those to us? And remember what we said about that recourse debt? We said, if you sign that note, you know, maybe years have gone by and you think, well, gee, that didn't work out, but oh, well. Remember this? Let's see. Did I erase the slide? I think I did. Let me see if I erased the slide. Yeah, it looks like I didn't leave that up there. But what was I going to say on that $3 million, $17 million example I gave you, right? You might hear from that bank saying, hey, you know, sorry, the Warriors didn't pay us back. And so now you need to, right? So you might get, whoa. Let's see what happened here. So I think that's where we're at. Boy, this is very testable. This entire slide is very, very testable. Direct participation programs are not safe. They're not liquid. You know, they don't have safety. They have a lack of liquidity. That's a guaranteed test question. I can't imagine any draw in which you don't get asked to understand that partnerships are not liquid. Lack of GP, I call this style drift. I mean, it worked out, but I told you Joe Lacob is a general partner. He's a venture capital guy. Now he's buying a sports team. You know, I can't tell you how many partnerships I've seen who have expertise in one thing, and then they try and do something else, and perhaps they're, you know, not as good at that as they were at some other things, right? You know, this is my first partnership, right? Length to terminate the partnership. We said these are typically can be up to 10 years. So 10 years or 15 years. So, you know, you need to be able to tie up your money for a long term. And remember, during that term, it's not very liquid. You know, I joke about hedge funds, which are organized as partnerships. I might say the gate is closed and sorry, you can't have your money right now. Suitability, clearly stated suitability standards must be in the prospectus if it's a public program, or in the private placement memorandum if it's a private program. The rep, that would be you, have to make sure it's suitable for the customer by ensuring they understand the risks of the different types of programs and that they're in a you know, situation to benefit from the tax benefits, right? The flow through. I mean, because if they're not, then this wouldn't be a good idea for them. And this is an overview of what we discussed in this lecture. We said partnerships are one of the investment vehicles that you're tested on. And we said, you know, it's either going to be a public, it's either going to be a public program or it's going to be a private program. You know, we said the syndication fees are limited to 10%. We said the GP provides the management. They have unlimited liability. They have a fiduciary responsibility. We said you as a limited partner have no management responsibility, wouldn't want any management responsibility. You're not a fiduciary. And then we said you're going to get, let me change this. You're going to get a K1, which either says your partnership is providing it as a PAL, it's throwing off PAFA's activity losses, or you're going to get a K1 that says it's a PIG, it's a passive income generator. And we said they like on the test to say your customer has a large amount of passive income. What kind of partnership might he want to participate in? And you'd say a partnership that provides passive activity loss. Okay, well, I'm going to try not to forget this time. Like, subscribe, share, all that good stuff. If you have any questions, make sure you put them wherever, you know, reach out, ask them. As I mentioned, I think this is sufficient. I mean, 3, 4, 5 partnership questions on 7 max, you know, 2, 3 SIE, more like 2, 65. I will putting in the playlist for 65 SIE and Series 7. And then 65, maybe 2, 3 questions. So this is kind of like margin. I would hate for you to overdose on this. And so maybe I'll just put that in the title or somehow like I did on the margin. I think watch my margin lecture once, you're good to go. Watch the partnership lecture once, you're good to go. Oh, wrong one. All right, so I will see you next time. And we'll talk, who knows what we'll talk about. I'll put out, see what you want to talk about. I'll probably redo that suitability explication lecture at some point.